Joining us right now for more on the markets as we get ready to kick off the first full week of trading in 2025 is Dan Niles from Niles Investment Managing. He's the founder there. And Dan, what do you think about what Mike Santoli was just laying out, this idea about levels that need to be tested, things we're going to be pushing on? How are you feeling about the year?
Well, I think Q1 earnings and guidance is going to be key to this because you've got a lot of things that need to get taken into account. The first big one, honestly, is at the end of Q3, the US dollar was at 101. It ended the year at 108. So you've got a 7% move in that, and you're going to have guidance that a lot of these companies are going to give either for the full year or for the first quarter. And S&P companies get about 30% of their revenues overseas. So you're going to get a 7% hit to that immediately. And for the Magnificent Seven, a lot of their revenues, it's closer to 60% overseas. So you're going to have to deal with that. The second part of it is some of the calendar shifts you're seeing, like they shouldn't really matter, but you've got Easter moving out from the end of March to April 20th. And so for companies that only guide a quarter in advance, et cetera, you may have guidance below expectations. So you've got a lot of things that I think it's going to be interesting to see how stocks react to this guidance. And multiples are really high. Let's not forget, we are exiting the year at about a 25 times S&P 500 PE. You go back through history, and when CPI is between 2.5% to 3%, the trailing PE is closer to 19 times. So valuations don't give you a lot of room to maneuver. And so that's why I think this year it's like one of the widest range of outcomes I can think of. And I think it really hinges on the path of inflation in terms of whether that multiple can hold or it contracts by 20 to 30%.
So last year at this time, you had top picks like Amazon, Meta, Texas Instruments. I was a little struck by your top pick. You've got 5 top picks, but the first one you listed was cash. When's the last time you did that?
Well, the last time I picked cash was in 2022, and the market ended up going down 19%.
Ah.
So, yeah. So we'll see how this year turns out. But I think especially to start the year, you're going to get a 4% yield in money market funds if you have cash. I don't think that's a bad place to be. Now, if you go through the rest of the picks, there are individual stocks that I hope can get through even if the market goes down 10 to 20% this year, which I think is possible. I think the upside is up 10%, but I look at Cisco, where we think you're going to have the last 2 years you've had AI spend to build out that infrastructure. I think this year you're going to have companies wanting to get to that data, move that data around, network that data. Adtran is helping companies bring fiber to the home on the telecom side. British Telecom, Deutsche Telekom in Europe is doing that. And in the US, you have BEAD funding bringing broadband to underserved communities. Those funds are going to start to roll out in the middle of this year. I like the bank stocks because with the new administration, less regulation, tax cuts, that should really help those stocks. And don't forget, 2023, we had to deal with the bank failures of Silicon Valley Bank, First Republic, Signature. And so even though the S&P is up 23% or so over the last 3 years, the bank ETF, KBWB, is down about 4% over that same period of time. And then the final pick is the mid-cap value space because, you go back to COVID, a lot of infrastructure spending there. Then the last 2 years, spending on AI infrastructure, and the mid-cap space has just been sort of left for dead as all the money is congregated into 7 stocks. And so you've got mid-cap, small-cap value names trading at 17 to 18 times trailing, with the S&P sitting up at 25 times trailing, and they've underperformed by about 35 to 49% over the last 5 years relative to the S&P 500 that's up 82%. And just been left for dead. And I think this year, especially if we do get a pause in AI spending, which I expect by about mid-year, I think a lot of that money is going to come out of the Magnificent Seven and try to go into these other areas of the market like small and mid-cap value.
The big argument against small cap in particular has been as interest rates rise, they're going to have a tougher time. They're not going to get those hoped for eventual lower rates that you've already seen bigger companies able to qualify for. things could get a little tougher sledding. Jason Trennert was here just a little bit ago, and he said that he would stay away from those stocks for this moment because he wants to wait till after there's a recession. That's when you really jump into those stocks.
Yeah, I mean, that's why mid-cap value is our top pick, or one of the 5 top picks that we're looking at, because they are a lot more defensive. If you go back and you look at what happened during when the tech bubble broke, or during that 22 period of time, they held in a lot better than the market. And because they're bigger than small cap names, they tend to have, better profitability, better ability to handle it if rates do go higher. And that is one thing I'm definitely looking at, because the other side of, when CPI is between 2.5% to 3%, you've normally got 10-year Treasury yields, if you look back in time, about over 100 basis points higher than where they are today. So I can definitely see a situation much like in 2022, when you lost money in bonds and you lost money in stocks, if inflation really picks up, because don't forget, these pro-growth policies are wonderful, but the other side of that is you've got low unemployment sitting at 4%, the economy is already growing at 3%, and the policies coming in are pro-growth for the U.S., but they're also somewhat inflationary, such as immigration policies or tariffs. And so I think you really need to watch that, and the market really cares. As you saw when Jerome Powell said our inflation forecasts have, quote, kind of fallen apart, and the market dropped 3%. So to your point, Becky, that's why I think mid-cap's a better place to be than small cap, which is why we went with the IJJ as one of our top 5 picks.